I can, we can begin with a quick introduction. I can just do like a quick introduction about myself, and then Abhishek would love to know a little bit. Like all of us have know about you, have read about you, but like would still love to know a little bit about you, about Tracxn, and about your angel investing journey as well. Right. So about me, my name is Karan. I work at Meta full time. I lead marketing for Instagram and Facebook in India, and I've been a two-time founder before Meta, and Accelerate is a passion project that I've started, with a friend Apoorv Chamaria, and essentially Apoorv is one of India's best investors, and essentially at Accelerate we're trying to do two things. One is we're trying to build one of India's best consumer accelerators for early stage founders to help them build large consumer businesses. And secondly, we are building this community of super angels for people like us to kickstart their angel investing journeys. I've been investing for 3.5 years now. I've invested about 60 plus companies, and I essentially do consumer internet and consumer enablers. And yeah, essentially the idea of this community and these sessions are, how can we tell more folks about angel investing as an asset class, learn from some of the best people in the industry, what has worked for them, what are some mistakes they've seen in their journey, how to build deal flow, how to build their brand as an investor. And today we are super excited to host Abhishek as part of our Super Angel community. Right. Of course, Abhishek is a co-founder of Tracxn, one of the best listed venture funded companies in India. And Abhishek is a very active angel investor with 100% tech investments in companies like Delivery, and so many more. Right. So Abhishek would love to kind of, know a little bit about your journey as well, like about what you're doing right now, about your angel investing journey, and we can then take it from there.
Right. So quickly about me. So I grew up in Marwadi family. Business was always part of our discussions all our lives. In 98, I was among top 100 J rankers and then went to IIT Kanpur, did my computer science. And IIT Kanpur again was a hotbed of entrepreneurship at that time. So my passion for starting something got new like fire at that time, and started my career in tech. Worked with Amazon and Yahoo in their tech teams. Both were very interesting places to start careers. Yahoo was what should I say? Yahoo was conglomerate of 200 internet businesses at that time, and every week somebody would come from US and talk about their department. So I learned about every vertical in internet at that time. And Amazon, I was there in 2006. This was a year when Jeff Bezos launched AWS, and everybody thought that was the crazy. Like Jeff Bezos, somebody wrote in the media so that has Jeff Bezos gone too old. So I firsthand saw how some of the most powerful ideas can be misunderstood for in early days. So and that became relevant in the subsequent part, and I'll talk about that. But beyond that, Amazon was a great place to learn like long-term thinking, regret minimization, power of mega ideas. So it was a great place to sort of learn about what a scaled company, which is innovative and looks like or should look like. And then by serendipity joined Axel in 2008. I was few programmer turned investors. I actually didn't know there is a job. There is an investing job at that time. There are hardly 10 funds in India. And but I realized that something interesting is happening. They were looking for somebody who knows internet. So I ended up spending 3 years with them. My claim to fame is that I helped them lead the first round in Flipkart.
Wow.
There is a book called Big Billion Startup. I don't know if you've seen that. That actually talks about because the investment was quite full of drama. So there is a lot of narrative around it. And then when I looked at Flipkart closely, I realized that how businesses should be built. So that sort of told me that these stories are not just valid for Bay Area. You can do something like this in India too. And post Axel, I left and started building something again. I built a women e-commerce company called Urban Touch. And then in 2013, me and Neha started Tracxn. And after leaving Axel, my angel investing journey started by serendipity. I had met so many founders at that time, and because of which the deal flow used to come regularly. I met one of the founders of Delivery because I was in Delhi at that time for 2 years and I was looking to hire. somebody connected me to Mohit, and I was looking to meet him to hire. He is also junior from IIT Kanpur, so he came out of courtesy and said, "Look, I'm not looking to join, but we are starting something." And then I ended up investing in them. And I've, because my first institutional investment was Flipkart and then personal was delivery, I thought I was lucky at it, so I continued investing. And over these 15 years, I've invested in over 200 companies by now.
Wow.
And I think it's also vintage. I think as you meet more people over years, you get a great network, and then you keep getting interesting deal flow. And in many cases, largely I have recycled the money I've made in 3, 4 companies, because your outliers give you back so much that you can keep investing that. So that's briefly about me and how I got into my angel investing journey.
Amazing. And Abhishek, if I may ask, like I think you touched upon it briefly, but what was the motivation for you to start investing? Like, was it like intellectual simulation? Was it just being close to great founders and great ideas, or was it also because it's an exciting asset class then and even today?
So honestly, at that time when I left Excel, I was just had turned 30. I didn't fully understand investing asset class because I had not I had just learned to put money into FD by then. I had not taken any public market exposure, so I was not thinking of it as an asset class. It was more muscle memory. For last 1,000 days, I was meeting companies and trying to invest in them. So whenever I used to meet new companies, I would keep wearing that hat. It took me a while to get out of that, and it probably happened because of muscle memory. And obviously, when I met delivery, I knew they're up to something really big,
Hmm.
and it was sort of very natural. It was not very well thought through decision that I want to start investing.
Amazing. And like out of your 200 investments, I mean, like just to before we start, like what have been some of your notable ones, your best investments, and how did you source them, or how did those investments happen?
Okay. So I think I have largely, there are maybe 6, 7 which stands out. So Flipkart, delivery, then Slice I invested through one of the vehicles that I had at that time. Innovesa, Rupeek, um, then Gamescraft is doing well now. So Gamescraft I did personally. So like 6, 7 of them. Largely it was either through a friend. Um, Either I knew them. So Gamescraft, I knew one of the founders. Flipkart founders were my ex-colleagues at Amazon, so it's actually somewhat different, but always recommended very strongly by a friend.
Hmm.
So in delivery, somebody recommended Mohit strongly to hire, so somebody spoke very highly of them. Slice, one of our employees was a great close friend with them, and they said spoke very highly of Rajan. So in many cases, they were either direct friends or somebody spoke very highly of them. Flipkart was a different case because it was post-launch. I think it was largely customer reviews.
Hmm.
Everybody you meet, you would talk very highly of them. So no, not only they were recommended, but I think the reviews were exceptional. So in companies which have launched, I think reviews is a great way to know if they are a great investment or not.
Hmm. Very interesting. Super. And generally, like what's your like investment philosophy, right? Like do you have across your 200 investments, like do you have a particular thesis, which you follow? Like do you try to come in very early, or is it like just based on like if the founder is amazing, the team is amazing, you would go at like you would invest irrespective of the stage, irrespective of the sector?
So I am quite sector agnostic. I have invest sector and stage agnostic. I have invested in like companies at all stages. Largely, if I would divide into 3 things. Um, First is obviously market. Um, Within market, I look for TAM and moat.
Hmm.
Um, TAM, there are different ways to look at TAM, but the way I look at it is, if I were the founder of this company, in 30 years, can I scale it to, let's say, 10,000 crore in revenue or maybe 30,000 crore in GMV? So this, I remove the founder as a variable. I assume that I am running this. Can I really scale it to that number? And I take a much longer time frame. I assume 30 years. I don't assume 5 years, 10 years. And you will realize that when you put such a high bar, things become slightly easier. The other thing that I use is proxy. When I was looking at delivery, I knew FedEx and DHL are very large companies. So you knew that in this similar space, you can create a large company. Or when we were starting Tracxn, we looked at Tracxn was solving for private markets, and in public, similarly, public markets also have investors, and their companies like Bloomberg, Refinitiv, FactCheck, they were really large companies. So there was a parallel in a different universe which has scaled well. So I also look for parallels either in adjacent markets or different markets which look similar. The other thing that I look for is once I meet these companies, they are frighteningly large. So you come back home either thinking that maybe I should go and join this company, or I feel maybe I should have thought of this idea. It's frightening. You really get shaken to some degree. Um, so these are few things I look for in the TAM side of the market. Moat is pure defensibility, which essentially means that if the current CEO of that company leaves and wants to start a competing company, how easy it would be for them to replicate. Think about if Jeff Bezos wants to like start Amazon all over again. Would it be easier for them to replicate or disrupt that market? Or if the current CEO of Nike wants to leave and start Nike competitor? That truly talks about moat. So the guy who knows in and out of the business, how easy it is going to be for them to replicate the business. Usually all your profit pools are function of moat. If there is higher defensibility, you can make more profits. If there is lesser defensibility, there will always be going to be a pricing pressure. So this is on the market front. Founders might typically the way to I think about this is key. I'm going to pay these founders to meet them. Like if I usually let's say invest in 10 lakhs in a company, the founder is not going to meet me more than 5 times over next few years. So effectively, I'm paying like around 2 lakh to meet this founder, right? So did I learn enough from them? I have realized that good founders have figured out a lot of things in life outside this idea, and they always teach me something new. So when I meet them, I realize that did I learn something new which I had not figured out, they have figured out on their own because entrepreneurship is all about figuring out things. Right. So on founders, usually I come back very inspired by meeting them that I would really pay to meet these guys. So that really sets a bar for me. And third thing I really look very closely is execution. Because in a lot of cases I've seen a lot of great ideas, but founders are very smart, a lot of resume value, but they don't execute well. So in early days, there is very little execution to be judged, but their website, their deck, I would want to feel little slightly inspired by that. They've done a good job. They care about things. So these are three things I look at. Usually, I don't treat it like a checklist. I always think and try to trust my intuition that is this something which will become a very large company? And I'll tell you why. Out of 200 companies I've invested, probably 5 of them have sent money back.
Wow.
Rest are all growing. They are becoming large, but it takes a lot longer to get your money back, which essentially means that you're always looking for really large outcomes, like usually billion plus in revenue or 5 billion plus in GMV, if it's a GMV business. That is when truly you can make money. Like delivery has now crossed a billion in revenue, right? After 14 years of existence. So it takes a while to scale, but it should scale to that degree. And so that is what I look for in companies.
Amazing. I think this is super awesome. And, like I'm going to like, we're recording this session. So I'm going to like refer to it, like always and, use it as a checklist for myself as well. Would love to kind of know your thoughts on portfolio building as well, right? So like across the 200 investments that you've done so far, right? Essentially, how, because like a lot of us are early stage investors, like we're starting our journeys today, right? So how much should one invest, how many companies should one do in a year, uh, uh, you know uh, till when should you kind of hold capital, and if there's an option of an exit, when should you take that? And like for example, in your case, you mentioned that about 5 companies have returned capital, you're still invested in a lot of them still, right? So would love, like, should one invest regularly, or should, I mean, one invest in buckets based on certain trends? So would love to understand about, like, how can one start building their portfolio in terms of number of companies, check size, sectors, and entry and exit opportunities.
Correct. So I think unless you have um, differentiated access in the market, you should invest slow because your deal flow will get really good every year. As people know that you are investing, you will start getting invited to great and good and like greater and greater, better and better deals. So I usually tell people to invest slow. Don't um, the worst thing that you can do is you come out, you invest company, write in money in 5 to 10 companies quickly, and then after 1 year you realize that two of them shut down and you start getting cold feet. So basically, I would advise that just play slow, invest very little money, whatever you are happy to lose. Keep investing only that much, and invest when you're really, really convinced that this is something which will be really big. Because good companies keep getting created. Like over last 20, 25 years in my career, I've seen that every decade or every few years, it feels like the largest plays are done. But again, you will find something very interesting. New disruption keeps coming up. So at least for next 20 years, I feel that there will be no dearth of opportunities to invest in. Just play slow. Like uh, for example, at Axel, I would have met maybe 500 companies and said yes to maybe two to three.
Wow.
So 100:1 is not a bad thing, right? So don't be impatient. Just hold your cards and play. You have to be right just once in a decade. Um, and in many cases, one large company. So, for example, in the first cohort in 2012 to 15, when I was investing, maybe 11 to 15, I invested in 10 companies, and 99% of money came back from one company. So it
Wow.
didn't really matter if you did the other nine or not,
Mm.
right? So you just have to wait for a one which is really, really exciting. And it's okay to miss opportunity to invest in good ones. Don't doubt yourself that, oh, there was a great company you met, you said no, but it became large. It happens to everybody. There's no points of missing out. I think precision matters more than recall in this business. It's okay to say 10 no to 10 companies which came in your network. You really met them, you didn't understand, and you said no. I think it matters if how many times you said yes and how many times were you were right. So that is one thing. Second, what I have done from an exit perspective is um, because 99% of money got made into one company. If I had sold that company early, then my entire return would have been much lesser. IRR would look great, but absolute amount would be much lesser.
Mm.
Um, so you can sell a bit. So I, after first 6, 7 years, I sold a little bit, maybe 10, 20% of my holding. But after that, I kept selling when the market was at peak. So when you have 2021 like euphoric moment, when everybody is very highly priced, that's when you can sell a little bit, but won't sell everything. You have to let your winners like scale up. You don't be in rush to take that money out because you will not be right too many times. Only once in 10 years you will be right, and that you have to let scale, and then you extract most money out of it.
Interesting. And then you do you reinvest as well in like in your winners as well? Like, do you double down on them as well?
Very few times I did invest again in delivery. There was after Nexus's round, there was a secondary available. Then I ended up buying that, but usually not by design. I have reinvested in maybe 2 to 3 companies so far.
Got it.
Uh, Either in some cases I bought very little in the first round, so I realized that I have some mind share to invest more. Usually, I don't invest so much because we don't have a lot of capital usually, and if your capital pool increases, the inflow of deals will increase significantly more than that. So you will never have too much money if you're investing your personal money.
Mm. Correct.
So play very different, like play very conservatively. It's a very, what should I say, very aggressive asset class, but you have to play slow. You have to, like, I usually try to put least amount of money the founder is ready to take from me. So you can, like, you always have to have your fear hat along the greed hat. So one of the other mistakes I've seen people do is they really like a company and put like 30% of their budget into one company, maximizing greed. So you have to be balanced on greed and fear in this asset class.
Mm. Yeah, I think one thing I'm really getting is that, like, don't be after FOMO, right? Essentially, like, go slow and, like, the more you invest, the more you learn, right? So essentially, like, no point being very aggressive, and essentially, great opportunities will keep coming, right? So like, even if you have a big anti portfolio, right? That still means that at least you're getting that deal flow, right? So it's important to get it right rather than maybe like spray and pray, invest in too many companies and then essentially getting it wrong. And like again, going slow and not investing a large amount in one particular company. So if I were to look at angel investing as an asset class, right, like, and compare it with let's say more established asset classes like mutual funds or real estate or even the capital markets, right? uh, I mean, do you have a benchmark in terms of the realized returns that angel investment gives as compared to a lot of these existing asset classes?
So, unfortunately for private markets, the variation is really high. I know people who are probably got nothing out of their angel investing journey after investing in 20 companies. And
Oh my
I
god.
know people who have made more than 100% IRR too. So it has been a very varied, very, very varied journey. There is a lot of role of luck and serendipity in this business. So I would consider it more closer to lottery business than uh, so FD is like conservative mutual fund is somewhat more proven now. So if you do a reasonable step in a mutual fund, there is a reasonable chance that you'll make 10% plus IRR in India. You should do a reasonable job at selecting good mutual funds, or maybe 15% if you're doing really well. But in this asset class, I would say if you don't have differentiated access, it's better to invest in funds
Hmm.
than doing directly. And if you want to really do direct investment, then like think of it a 10-year learning journey.
Hmm.
So at least make sure that you're investing for next 5 to 10 years when you're starting your journey. So play really slow. And one thing that I do is I don't meet too many companies. Otherwise, you get impatient and you say yes to somebody who's looking marginally good. I look at the deck and I join a call only if I'm really sure that I will invest in this company.
Hmm.
And then from 100% yes, I will go to a no if the call doesn't go well. So in some ways, like somebody has strongly recommended that you should meet this person, or some really high signal has come for me to get on the call. So that really helps. Otherwise, you keep saying no to random deals. Or you keep saying yes to a lot of average deals because you got somewhat impatient after meeting 20 companies and saying no.
Hmm. Got it. And what's the right metric to track in terms of returns? Like a lot of people talk about IRR, and then there is multiples on invested capital as well, right? So, like, is there a particular metric that you track for your investments?
So I usually, if I don't see myself making 100x on the investment, I would not do the deal.
Hmm.
And so, for example, in delivery, share price increased 800 times since I invested.
Wow.
So at least 100 times is what I expect. And you obviously don't make 100x on the portfolio because 9 out of 10 deals will die.
Hmm.
So you still, I expect on a portfolio level to at least make 10x.
Hmm.
But on the individual deal, when I enter with a reasonably high conviction that I'll make 100x on this money invested.
Interesting.
And this can even be true for later stage companies. So, for example, in Innovaser, we invested 100 million pre. But even then, it was visible. At least I thought that we can make 100x on the money invested.
Wow. So it could have been a $10 billion outcome, even
Uh,
when you invested. Yeah.
correct. Now, think about Apple, right? If you had invested that even 10 billion or 50 billion in Apple, you will still make 100x, right? So sometimes these like large companies can really scale over time,
Hmm.
right? So even in public markets, if you look at good assets, they can make reasonably large outcomes. So at least in private journey, when I enter, I look at this as a benchmark, and the mortality rate is high, but I think eventually outliers pay up for all your bad decisions.
Yeah. Interesting. And you talk a lot about access, like differentiated access, building great deal flow, right? So I have a two-part question. One, essentially, like if you can just take us through, like what are some different ways through which people can invest? Like you've talked about funds, you've talked about syndicates, direct cap table, and then essentially, like how does one build their differentiated access? How does one build great deal flow so that they can get access to, some of the best opportunities?
Right. So usually, uh, if you don't have a lot of friends working in various funds, I would say look at good early stage funds. In India, at least, I feel that early stage funds, pre-seed, seed, some Series A, like even in Series A, it's harder to make money. Those are funds where if you see, I would evaluate one simple parameter: has this fund produce two good winners in every fund.
Mm.
And if you see that consistently happening, they will return a lot of money. Unfortunately, those funds will you will find it hard to even get access to those funds because there is always excess money. Um, but you can try reaching out through networks, close common friends. That is usually a great way to enter. Um, Syndicates, some syndicates have done a good job. I think, again, look at their success stories. Unless they have hit upon a very large outcome, they usually don't know what they're looking for. So you should look for funds or even syndicate leads who have good winners. Winners means at least few of their companies have crossed 500 million in market cap. So a pre-seed investor who is investing in, let's say, sub 10 million market cap, if they have one company at 500 million, at a portfolio level, they will return good money.
Mm.
So that is one, that is other parameter, that is other subsequent set. If you want to do somewhat of a direct, then I would say make friends with other active angels or other micro VCs or pre-seed investors. At pre-seed, usually a round of $1 million is subscribed by multiple people. So there is more sharing happening at that level. After Series A, usually funds want 20% ownership. So the sharing is a lot lesser.
Mm.
And so sharing happens more at pre-seed, micro VC, super angel level. So make some friends there. Usually people will invite you for a particular experience. So for example, if I'm doing a deal and there is a lot of marketing related, what should I say, motor or skill set required, then I'll reach out to Karan and say, oh, you look at marketing at Meta, maybe you can give them some advice. So you have to bring one proprietary skill set to the table. And sometimes we try to underestimate what we know because we think it's usual. A lot of people know Instagram marketing, but that particular angel doesn't know too many people in that
Mm.
category.
Mm.
So in most likely in his network, you will only be among one or two people who know that skill and is looking to invest. So it's so when you meet these people who are investing, just talk about one or two things that you can bring to the table or where you can help the company.
Mm.
And smartest of people will have these skill gaps. So for example, most tech invest founders wouldn't know about finance as much. So a CFO finds it very easy to get accessed as an angel,
Mm.
and they end up adding value. We have bunch of people from finance on our cap table, and during the entire journey, they came handy. They gave us some advice. So you always will have something which you think is commodity, but like a CFO can say that, oh, there are thousands of good CFOs in India. Why would I get differentiated access? But a particular angel who is investing and who is looking to help company fill up the cap table will only know one or two CFOs who are investing. So you have usually a differentiated sort of value add which you have to like talk about. You have to make sure ki the particular person you are meeting to get deal flow is knows about it.
No, I think very interesting. I think Bhavesh has a question. Bhavesh, you want to go ahead?
Yeah, hi, Abhishek. Abhishek,
Hmm.
so like you rightly said, that a lot of the companies, don't really become your unicorns and highly valued companies, which give you a very smooth exit early, later on because there's high demand for those companies. So, like say 80-90% of the companies would either die or they would just become a small SME kind of a business, turn towards profitability and then run a small shop, right? So what's been your experience with regards to, now monetizing your investment in these companies from a dividend perspective, corporate
Yeah.
governance? Is it easy or it's difficult? How's the process? And then if at all, have you planned an exit from such companies? Then what's been the case when there's no demand for those shares of those companies?
Yeah, usually not much comes out of those businesses.
Okay.
But what I have started to tell people is to look at SME IPOs more seriously. Because if you look at SME IPOs, there are a lot of companies which have revenue between 20 to 50 crore who are able to list and unlock the value. So it's a good unlock for you. It's a good unlock of their promoter, the founders also. So that is a very interesting option that doesn't exist in many countries outside India. So India has it's a very fertile ground for unlocking value. Uh, we don't appreciate it as much, but I think there is no other ecosystem where such a what should I say predictable exit value unlock path exists. So a lot of my smaller companies now I have requested them to explore it, not just for giving us exit, but more for their own value unlock. And I see that many of these companies look at it more seriously, like in, for example, E2E networks, Loss Eco. These were two venture funded companies who went SME public in SME exchange. And but it's very hard to otherwise push founder to say, "Okay, give me dividends," or try to sell stock open in the open market. That usually has not helped as much. But I would not stop you from trying that. You should try that and see if it works for you.
Thanks, Abhishek.
Abhishek, in your journey, like what have been, yeah, over the last 200 investments, like what have been some 3-4 mistakes that you have made that, like you have learned from?
So biggest one is, I think, getting into FOMO is all the founders around you respect, or all the investors you respect are investing in a deal. You're not 100% on board, but you are like 90% there, and you end up saying yes because the deal is about to close. I have also made good investments through that, so I won't say it's completely wrong, but those are the cases where I've regretted it more. Other than that, I think sleep over. If you meet a company, you get really excited, sleep over it for a day or two. Don't be in rush. So, because in most cases, we are all doing more than a full-time job, right? You have kids at home, you are doing a job which is very hectic. There is very little mind share. So there are times when it happens that everything checks out, but you're not 100% convinced. So I say keep invest only when you are 100% convinced, because those are the deals which you really enjoy. Don't nag or don't bother founders too much. After investing, sometimes you get over enthusiastic, you send them a lot of ideas. Usually people don't have time for that. So I would advise people not to get too over enthusiastic, let people do their work, and whenever they need help, you try to help in whatever possible way.
Got it. Super helpful. I think like there's this quote as well that you're not the anchor of the ship, right? You're just a passenger, right? So like eventually it's the founder's show, and maybe like only kind of help when the founder needs it or founder reaches out, rather than trying to be running their operations on a day-to-day basis. So interesting. From an India perspective, Abhishek, like what are some opportunities that you are excited by in the next, like let's say 5 to 7 years?
So there are mega trends, but I would caution that good deals were not mega trends when they got started. So Flipkart was not a mega trend at that time. In fact, everybody had tough time investing in them. Their first round took almost 8 months.
Oh my God.
They practically met every smart VC, and everybody said no because it was not a part of any trend. The macro was not supportive. There are only 2 million transacting users in India. There are 20 million internet users. Payment was completely broken. Trust on internet was not as high. So there were 100 reasons to not back this. And the biggest question was that this company will need at least 20 million to become profitable. And how in earth will we get 20 million for this company? Because nobody was investing that kind of money at that time. So every possible answer was no. Question was leading to a no. So in those cases, I think not like, so you have to be open to a lot of new ideas outside looking at mega trends. Usually looking at global markets have really helped. So in every case, there was a parallel in some market which scaled well. So that usually helps. But coming to mega trends that are popular today, I think I'm a big proponent of brands and overall from India. People are not realizing that like if you go to a mall today, look at Ambience Mall. Every brand is global there. Very few Indian brands exist there. And those brands had fortune of getting started tens of hundreds of years in past. That doesn't mean that Indian brands won't reach there over next few decades, right? So we will produce a lot of brands which will be globally dominating. So we are underestimating that today. Like today, for example, Lenskart can be a dominant player in 20 countries globally. There is no reason it can't be. Or for that matter, ICICI Bank can actually become a dominant player in 20 countries over time if they want to. And a lot of foreign banks exist in India, so banks can go global. So we are underestimating the opportunity for Indian companies to go global and be globally dominating brands. So D2C is a big area. I think China plus one is a big trend. I do worry about eventual automation because in manufacturing, unless you automate really well, you can't be globally competitive. So I think we have to cross that threshold before it become very interesting. But I see a lot of good manufacturing startups coming out of it. Good tier one teams are starting. They have solved something really good, and we can scale that. Vertical SaaS is a bread and butter of India. Horizontal SaaS is hard, but vertical SaaS is relatively easy. You pick a niche industry, there are only going to be 5 players, you keep fighting. And then eventually, because you're based out of India, you can build a reasonable product and get some market share. So vertical SaaS will continue to remain bread and butter. And so these are broadly few things. Other niche areas like space, there are a lot of good companies, but these are again very, very hard to evaluate and judge. AI is similar other big trend, which is where we will produce a lot of good companies, but it's very hard to evaluate from outside what will become large. So you need a lot of domain expertise before you can sort of evaluate some of these companies. Um, Early days in drug discovery, healthcare, I feel India will produce, like every country starts with them being an outsourcing hub. So Korea produces a lot of beauty brands.
Mm.
It is because 20 years back, Korea was an outsourcing hub for all these cosmetic brands. So every industry where India is an outsourcing function today will eventually produce brands or leading players in future. So even for Tracxn, for example, all data companies produce their data from India. They can be largest brands globally, but their largest data production teams are in India today. So because of this investment, because of outsourcing, you invest in infrastructure and eventually you produce companies in that market. So all of that is open market today.
Interesting. And I think you alluded to healthcare, right? So, and you also talked about generative AI, right? So, like, if you're not from that background, or you don't have that domain expertise, then how do you kind of evaluate such an opportunity, right? Because today, I mean, everything in generative AI seems very exciting, right? But like, in terms of applications, in terms of whether these companies will be able to scale, build their own tech stacks, if you don't have that domain expertise, maybe you're not best positioned to kind of judge it, right? So, like, how do you kind of evaluate those kind of opportunities today?
It's very hard, and it's likely that you will make a wrong call. What I have done in some of these cases that I've leaned on judgment of people around me.
Hmm.
So, for example, I invested in Agnikul, but because Speciale was investing and they were close friends, um, I co-invested along with them. So I knew there is something happening. SpaceX is a large company, so a private space company can be created. So there was a proof point of a large outcome. And then, can these guys do it? I leaned on their judgment. But if they were not there, it's very unlikely that I would have been independently be able to make that call. So you have to lean in on other people's judgment at times. But I looked at parallels. So SpaceX was there. It builds the case that something like this is possible.
Hmm. Interesting. And from a proxy perspective, like essentially in consumer space as well, right? Like when you talk about a lot of generational brands in India existing today, either they have an option of going global, or a lot of new D2C companies can become those large brands in the next few years, right? So, like, are there any, do you have any proxies here in India as well, that these are sectors in the consumer space that, are likely to go up in the next few years?
So in consumer B2C brands specifically, usually two things make it much more clearer. If they have reviews. Reviews is a great place to start. However good the brand says or looks, but if the reviews are below 4 in Amazon, then it's unlikely that it's a great outcome. It can be anything. You don't know from outside. Sometimes I've used the product myself and I feel it's a great product, but reviews say otherwise. Um, so reviews is a great way. Secondly, I look at parallels, see what are the largest brand in those markets. And so that really helps you decide that. D2C is relatively easier to evaluate, in my opinion, because by using common sense, you can relate to that market to some degree. If you're looking at a shoe brand, you can just plot all the shoes in the market and be able to decide if there is a gap or not. So as compared to enterprise SaaS or AI or space tech, this is probably the easiest sector to evaluate. In D2C specifically, for example, I look at product market fit. Is there a gap in the market? Secondly, have they hacked something in distribution? So they have to raise bar somewhat in distribution. I think because brands is also a distribution game. So distribution is a core skill. So outside building a great product, have they raised the bar in distribution? I met a lot of brands, for example, they have just gone to modern trade and they are making very little margins and giving everything to the brand or the retailers. They have scaled, but I know they have not raised any bar in the distribution. So eventually, there may be a time when they don't, and the repeats are may not be great.
Hmm.
So you have to look at hacks in distribution and they raise the bar there.
Interesting. Great. I think if anybody has any questions, please feel free, to ask them. We can take them up now. But I think Abhishek, as a parting advice, to like a lot of early stage and investors, right? Like, what would be like? I know you've talked about taking it slow, not being in FOMO, evaluating the companies in terms of, TAM and moat, and essentially looking at proxies and a larger vision. But like, if there's any like last piece of advice that you would give to early stage investors, what would that be?
Right. If there is a doubt, the answer is no. Like, you put money when you are really convinced, and there is plenty of fish. So a lot of times you feel that, oh, I won't get access to like such a great deal. I won't get access to it again. There are plenty of deals. We are fortunate to have born in a time when everybody around us is starting up. So we are producing startups at an insane pace. These things don't exist. I started this journey 20 years back. Very few companies were getting started. So there was a dearth of good companies, not today. A lot of really good quality founders are starting and the velocity is only increasing. There is obviously some dip in last 3-4 years because 21 was just very crazy year. But on an aggregate level, we have come a long way in 15 years. Like, think about a IC meeting in 2008 when people are saying that how will this company raise 20 million, right? That is where we were in 2008.
Yeah.
And so there's a very big secular trend. We are in a, what should I say, Amrit Kal of India, both in terms of public markets and startup ecosystem. So you can just wait it out. If you're not sure, you're not sure.
Amazing. Great. Thank you so much, Abhishek. Like, really a lovely session. Thank you so much, for the insights. So it was great learning, from your experience, from your journey. Great collaborating with you as always. And, wishing you the best in your journey at Tracxn as well as your investing journey. And yeah, I mean, if there's any last questions, happy to take them up. Otherwise, we can give back time. Perfect. Okay. Thank you.
Thank you.
Thanks,
Thank you,
Abhishek.
sir,
Thanks,
and thanks
everyone, for your
everyone.
time. Yeah.
Have a great day. Bye.
Yeah. Bye. Thank you.